In today's video, we're going to contrast real disposable income versus housing prices. But does this tell the entirety of the story? We're going to take a look at interest rates historically as well. Let's get to it. Hello everyone, this is Sam from SaberiSixRealEstate and Remax Realtron Realty. As always, back with another video for you guys here today. As always, you can find my contact information in the description box with regards to my Gmail, my office information, and my Instagram. Feel free to go follow me on my social medias and get in touch with me if you have any further questions about any topics covered in this video or any topics covered in previous videos, or if you have any general inquiries with regards to the Toronto/GTA real estate market. For those who have gotten in touch with me, I appreciate the fact that you have. If I have not gotten back to you, I am quite backlogged, but I appreciate nonetheless. Lastly, feel free to subscribe, comment, rate, and review. Your support in that regard is greatly appreciated, but as I always say, obviously, you're not obliged to do so whatsoever. Only feel free to subscribe and like if you want to support this channel and you find my videos informative and fruitful in nature. Anyways, let's get to the point of today's video, which, as I said off the top, is real housing prices in the country of Canada and obviously the province of Ontario versus and contrasted against real disposable income. We're going to be taking a look at this chart via National Post, link in the description, credit to them, that contrasts real disposable income as indicated by the black line / curve on this chart versus Canadian housing prices. And this is not median, this is average housing prices as indicated by the red line / curve on this chart. As you can see from the horizontal axis here, this dates all the way back to 1975 to the most recent year, which is obviously 2021. We're not even in 2022 yet. So it's pretty up to date. And as we can see from this chart, up to 1999, real disposable income and housing prices were pretty tethered together. In the early half of this chart, so around the 70s and 80s, as we can see, real disposable income was pretty steady and moderate. If there was a dip, it was a moderate dip. If it was an increase, there was a moderate increase. But overall, in the long run, at least up to 1999, disposable income had been increasing once again at a steady rate. So the curve here was pretty stagnant, whereas the curve for the housing prices, the average housing prices, had a tendency to always be in bounds, whether when housing prices were higher than disposable income as indicated around 1981, or when they dipped below average disposable income as exemplified around 1985, 1986, 1987. Either way, it was always within bounds, right? When there was higher, it was within range of disposable income. When it was lower, it was within range of disposable income. After 1993 up to 1999, pretty much you can see both curves line up pretty flush. They're pretty parallel in nature, wherein disposable income and housing prices are very much so tethered together. Now, of course, here I have to mention the vertical axis on this chart does not represent the average prices or average disposable income, more so the percentage increase. Where we really break away from the pattern of housing prices and real disposable income being within bounds of each other and being in similar pace is around the mid to late 2000s, where, as we can see, real disposable income and real housing prices become completely detached from one another, wherein housing prices start to skyrocket and increase, and disposable income, although showing moderate, once again, marginal increases up to year to date 2021, by no means even close to the increase of housing prices. In recent years, the only moderation or stagnation of any kind to even a small marginal dip that we see from the housing prices here is in the 2016 to 17 range. Despite the large gap from disposable income, nonetheless, housing prices by itself here, as you can see, around 2016 and 17 did dip a tiny bit for a short period of time, which many, myself included, attribute mainly, not the only reason, but mainly to the foreign buyers tax and many initiatives taken by the Canadian government to put some, albeit limited, but restrictions on foreign investment. And the foreign buyers tax being the main initiative there, I saw firsthand in 2016 and 17, had quite an impact on that matter. But nonetheless, as we can see from the continuation of this chart, that was corrected for eventually, and prices continued to skyrocket with, once again, disposable income continuing to be greatly outpaced by housing prices nonetheless. And in the latter ends close to 2020 to 2021, we see a complete skyrocket of these housing prices. And this should be nothing new to you. If you've been watching my channel, I go through housing prices for condominiums on a weekly basis, on a bi-weekly basis, for detached properties on a monthly basis. If you've been watching this channel for a year, you should by now have a good understanding of where we have been for the last year and a half, where I have been indicating an increase in housing prices all over the map, with the sole exclusion of a minor dip wherein we saw a buyer's market for condominiums towards the latter end of 2020. That is the sole exception to this rule, whereas for all other property types, for all areas, I have been explicating throughout a course of a year and a half increasing housing prices, mainly in the city of Toronto and the GTA, but also in the country of Canada and the province of Ontario. Before I get into my personal opinions on this chart and give you a little wider context, and contrast it with a chart with regards to interest rates, let's take a look at a similar graph for the United States, just for simple sake of comparison, as also provided by the National Post as well. Here we see something vastly different, where an average housing prices in recent years is actually below real disposable income. And in certain cases, when it was higher than real disposable income, it reflects more so the earlier years of the Canadian graph, around the 70s and 80s, where when it was higher, it was within bounds. Sometimes it's right at real disposable income. Once again, the vertical axis here should not be confused for average price or average disposable income, but more so percentage change. Nonetheless, that clarification aside, the point stands here that we see a vastly different type of housing market within the United States than Canada. We don't see the same effect of housing starting to completely detach itself and untether itself from real disposable income. Simply put, and this is not my own special theory, a lot of people share this theory, housing within the country of Canada, especially within the province of Ontario, plays a far higher integral role to the overall health of the Canadian economy, and of course, derivative from that, the Ontario economy, than housing does within the United States. Canadians tend to see housing and real estate as a far safer asset class and investment than our neighbors to the south. As we can see from contrasting both charts, the 2008 subprime mortgage crisis did not have the same impact, not even near the same impact in Canada than it did in the United States. Part of the explanation, and this is where we're going to get into breaking down the chart here a little bit more, because I don't think it gives you the full story. It's definitely a very good measure and gives you a good idea generally speaking, but we have to take it within context of other charts and other factors here. And let's get into it in two orders, and these two orders are connected. Number one, this chart, and people who have been discussing it online make a certain assumption that real disposable income is one of the main primary bases for housing prices. That is to say, there is an inherent assumption in these charts that real disposable income determines housing prices at a very consequential level. And although I by no means want to deny that real disposable income is one of the key primary factors that determines and impacts housing prices, it's not the sole or even the most important factor, I would probably have to say, in terms of determining and impacting and affecting housing prices. In my frank opinion, that would have to be borrowing costs. Here, the first assumption, the first point I want to make is that although this chart does a good job explicating a certain aspect, right, a certain angle, a certain perspective of the Canadian housing market, to me, it is incomplete because it indicates to the uninitiated or to the everyday person who is not really much so involved with real estate that somehow housing prices are mainly premised upon real disposable income. That's not the case. And this is where we go into my second point and, continuation of my opinions on this chart, which is interest rates. That is what, in my frank opinion, what we should look at more towards than real disposable income is interest rates. So in other words put, in my frank opinion, borrowing costs and borrowing power is more important to housing prices than real disposable income is. Now let's take a look at the historical record in terms of borrowing costs. And here, courtesy of RateHub, we have the historical record, the historical graph since 1935 of prime mortgage rates. And from this chart, as we can see, before we get into the obvious, we can see in the early years up to 1956, the prime rate was around 4.5 to 5%. Then after 1956, there were certain minor flare-ups where the prime rate would go up to maybe 5.5 to 6% at the highest. Once again, around that range. 1970, we saw the first major increase in the prime rate mortgages in terms of 8.5% at that point in time. And when we go to 1975, the first year wherein the housing prices chart starts, the prime rate at that point in time was fluctuating between 10.5 to 11.5%. So looking at the housing part of the chart now, as we can see at that given point in time, of course, housing prices, due to a series of other factors, of course, as well, but mainly taking into account just prime rates, borrowing costs at that point in time were far higher than anything in recent memory. So of course, the higher the borrowing costs are, the lower the housing prices will be in terms of this strict perspective we're adopting here. And then in the 1980s, we see prime rates close to 20%. And clearly, when we fast forward to the parts of the chart wherein housing prices start to separate themselves from real disposable income, so from 2004 to really 2021, wherein the increase in housing prices becomes astronomical, what do we see on the historical graph for prime rate mortgages? We see lower prime rate mortgage percentages. So in this sense, from this graph and other graphs we can take a look at, prime rate mortgages and housing prices have somewhat of a inverse relationship. In my frank opinion, this is why we shouldn't exclusively look at housing prices as contrasted and compared with regards to real disposable income, because that is not sufficient. We have to also add the historical record, the historical trends for prime rate mortgages or any other borrowing costs associated with real estate ownership. This gives us not a complete perspective, because at the end of the day, this is not a hard science. This is not physics. This is not chemistry. This is not mathematics. But nonetheless, it provides us a far larger and more accurate image of the historical trend.